Hello all, welcome back. Today I have with me Mr. Mahesh Kabra, who's a very dear friend of mine. We both belong to the same industry, and rather than doing those regular individual videos, today we thought we'll do a joint video and share our individual views on different important topics about which investors would be very keen to understand and learn. So I have Mr. Mahesh with me. Mahesh, if you could introduce yourself.
Yeah. So I'm Mahesh Kabra, founder of TaurusCap. I have a wealth management and investment banking firm, and so I'm quite happy to kind of make this video together because we regularly keep exchanging thoughts about investment ideas. So quite happy with all this thing. So I'm more than happy with your introduction.
Yeah, so myself, Kishan, Jakhotia, I have been part of the industry for about 15 years now. I was earlier in corporate treasury profile where I was handling institutional accounts on the investments, post which I worked for companies like Religare and Kavi, and today I run this setup which is Reliable Wealth for the last 7 years.
Great. So very interesting, Kishan. Actually, when you gave me this idea about making a video together, I've been thinking because there are a lot of things happening around.
Right.
We have gone through 60 days of lockdown already, and so now lockdown is getting relaxed in some ways, and in some places being called as lockdown 4.0. So what do you think? I mean, it's good or it's for bad, or what do you think happening now?
So I think we've been having lockdown for a very long time now, and I think everybody understood that maybe the economic cost of continuation of lockdown would probably end up being more than the actual impact of the virus on the economy. So I guess since we are opening up a bit, that's something which is very positive for all of us. From here, we'll kind of follow a lot of data points in terms of once we open up, whether we see whether we are increasing number of cases, and I think the gradual progress which we will make in terms of coming out of this lockdown will probably decide how we basically feel about what we feel about the lockdown. But the fact that I think we are opening up, and I think we are coming to this understanding that today we'll have to work, open up and work with the virus also being around. I think that's something which we all would like to see, and we'll have to see how different economies open up and what happens after that. I just hope that there's no lockdown 2 again, which starts if we again see re-emergence of many number of cases. That's what I feel.
Yeah. No, I mean, to be very frank, I think there will be an increase in number of cases. That's my personal opinion, because I think till now we were under very strict lockdown and people were not moving out. So we had contained it in some way. But now people are going to move out to their offices, probably to meet people also. So I think there's going to be an increase in the number. But I think somewhere this lockdown of 60 days has probably helped people in getting accustomed that we actually have to take care of this. So I feel, yeah, there's going to be a bit of increase, and also, there's a lot of, people migrating, laborers migrating to, their villages. That's going to be quite a big, impact in terms of the number of cases that might increase even in the rural areas, which we were not seeing otherwise.
Right.
But yeah, I mean, you're right. I mean, the economic activity definitely needs to kind of, come back, and we have been hearing theories like, herd immunity and all that stuff. So yes, I think we have to kind of learn to live with it, and we have to resume the economic activity, because yeah, there's a large section of society which is getting affected because of it.
Right.
That's important.
Right. Now, the next question. As lockdown seems to be getting longer and the government understanding its negative implications, we now have a stimulus of about 20 lakh crore. So I would like to know from you, Mahesh, what are your views on the stimulus?
So look, I mean, my understanding is that I think it's quite a generous stimulus in terms of the overall amount. But what I see is quite a large chunk is also being pumped through, not directly by the government, but like institutions like RBI and the banking system, right? In terms of the like a collateral-free loans to MSMEs and all of that. So that liquidity was already in the system, right? So that way, even though it being a very large sum, people are worried about some deficit that the government might have to kind of go through. So people have to understand the fine print as to how this overall amount is being offered. I think it's quite good in terms of it's being offered to actually, start the demand side. So, right. So, a lot of people in the rural side, the lower strata of people will actually get good sum of money in their hands, which will basically they'll spend, and that will basically start the demand again. So, I think this is a very positive point in terms of that, just focusing on the demand side. And even on the supply side, helping MSMEs and this mid segment of industries who really need help, because I think working capital is going to be quite a big challenge for them. So that's my view. I think it's quite good that they have come up with.
Right.
What do you say?
So my view is that I think this sounds more like a liquidity-driven kind of a stimulus. Also, to an extent, I would probably say this as more of a headline management, because what I personally feel is that the kind of economic loss output which we would have, assuming the fact that we were a $3 trillion economy and maybe about 8 to 10% of economic output loss which we would have, percolates to about anywhere between 20 to 30 lakh crore of output loss, and the real stimulus, which closely is about 2 to 3 lakh crore, whether that would be enough to kind of stimulate the economy and to create that multiplier effect is something which we'll have to see. I think a lot of it would depend on how it would be implemented. But I am of the opinion that I think the government would probably have to do a little more as we go ahead. And also, I would like to believe that I think most of the banks, I think everybody in the system, like banks, were expecting that the RBI will try and address their, asset quality issues.
Correct.
There'll probably be extension of moratorium. There would probably be, more of direct benefit transfers, and maybe I think a lot more was expected from RBI and the government, which unfortunately doesn't seem to have now been given. I think as we go ahead, we'll probably see more happening. But I think government should do more is what my view is.
Okay, very interesting. Yeah, kind of agree. So now, this stimulus is in place. Economic activity is going to resume in certain ways. What are your views about the equity market? I mean, what do you see the way going ahead for equity markets?
Right. So I basically feel that I think equity markets will continue to have a very high level of volatility. I think they will all be driven by a lot of news which would be coming out both locally as well as internationally. The immediate short-term outlook on the equities is slightly negative from my sense.
Okay.
I think there are reasons for it. I believe that I think we are not fully opened up. Some of these major cities are still under lockdown, and probably that will continue for some more time. So it will have a sort of a negative impact is what I feel. I think secondly, there is a lot of uncertainty on earnings and growth. I think that will again be something which probably is not something which the equity markets would like to have. I think third, the recent quarterly results which came out, not any significant corporate would probably have come out and given a very good picture of the expected earnings going forward. So I think that's again a bit of negative. I think fourth, the new rhetoric which is building between US and China, I think again seems to be taking us back to those days where we would probably continue to have more of global economic impact in terms of how business is done. So largely, I think this is what I feel in terms of the equity markets. I think the short term seems to be a little negative for us. I think most of them have actually started discounting 2021 altogether, and maybe they're moving to 2022 in terms of their balance sheet and earnings. So for me, I would say that one needs to be very cautious at this point in time. Equities, I think it's better to stick with leaders even if the valuations are higher. I think one should go with large cap funds is what I personally feel. And I guess one needs to keep watching how news flows out and how one could probably try and take advantage of those news. That's what my view is on the equities.
No, quite interesting. Actually, to be very frank, I think pretty much everyone is considering that FY21 is a complete washout, right? We were already somewhat of an economic slowdown, and this kind of COVID lockdown kind of just increased it, aggravated it further. So I guess whatever we were expecting this year is actually not happening this year. I think all of it is getting postponed to next year. So, I mean, what I feel is, to be very frank, I think you're right. I mean, the volatility will be there in the market. The moment some country, comes up with some stimulus or some random news about some vaccine getting, having tests and trials, etc., and with positive results, I mean, all of that will become reasons for markets to kind of, jump suddenly any particular day. But if you ask me, I mean, fundamentally, I think, as I said, FY21 is a complete washout. I mean, economic lockdown, so the whole country was under lockdown. So I think for the next 2 quarters, corporate earnings are going to get hampered significantly. I think next 2 quarters are very significant to look for in terms of the company's earnings. And I think that will affect the equity market also. The moment you have, lower numbers or maybe loss-making numbers for some companies, you will see, corrections in the market. And only in the second half is when I see, some demand, pent-up demand of consumption, etc., which will basically come back, and you will see the corporate earnings coming back again. So if you ask me, I think the first half of this year is going to be volatile, but again, good time to invest. Again, use the second half also to kind of use to enter in the market. But if you take a 3-year view, I think it's a great opportunity. I think it's a never before kind of an opportunity. People who have been waiting to enter equity markets, it's a great time. Obviously, in a very staggered manner. And and across the spectrum, from large to mid to small, I think the opportunity is across the spectrum. That's probably what I get.
Right, great, good. So we move on to the next question now.
Yeah.
The next one is, what do you think about the debt markets, and how do you see them in the current backdrop, in the current scenario where there are a lot of economic headwinds there?
So, to be very frank, I think debt markets are going to go through a little bit more rough patch. I think we have been seeing it for the last 1.5 years, but I think there's going to be a little bit more of a rough patch. Some corporates may even use this opportunity, as because of lockdown, there's a working capital cycle has kind of really stuck, right? So some companies which might have actually been caught on the wrong end of this working capital cycle problem, probably might get into default situations, etc. So I think this whole year we might hear some more bad news about the debt side, especially on the corporate side. But I guess companies with stronger balance sheet, companies have low leverage, will be able to use this to their benefit. I think liquidity in the banking system will be available for people who can afford it. Companies without good cash flow. So I think it's going to be quite good for the companies which are in the good position, and it's going to be quite difficult people who are already over leveraged and struggling with their cash flow.
Okay.
Yeah, that's my view.
Okay. So my view is that I think there are positives, there are negatives both for the debt markets from an investment point of view. I think so there is a lot of liquidity with bank, which is roughly at about 8 lakh crores, which I think I say this as a negative, not as a positive, because I think banks have not been lending. They've been showing no inclination to lend in spite of a lot of pressure coming in from government and RBI. So that's not happening. That's a lot negative for us. I think the downgrades, what we are seeing today, is something I think which is happening across the board, across different corporates, and even international rating agencies also kind of coming out and saying that we will probably have a lot of struggle in terms of sustaining the economic growth. That's a negative again. The third and the biggest negative I would probably say is the fiscal slippage, which is where I believe that I think the last year we had a fiscal slippage of about 3.8%, which was against our targeted 3.3%. And I guess with more stimulus coming in, probably we will, of course, we'll have more. I think it's anywhere between 5 to 6% is what the general understanding is by different top international rating agencies and companies. So my view is that, yes, these are negatives. Of course, there are positives for debt fund investors. I think the positive is that the spreads between the AAA rated corporate bond and government security for the same maturity is quite high. So which basically will give you an opportunity that once the spreads start kind of coming down, you'll end up making a good amount of return. So that's basically, I believe, is a good positive for debt investors. The other point would be that we are going to be in a scenario where the interest rates will kind of get softened out over a period of time. I believe that's again a good positive. So investors with appetite for good long-term debt funds and even short-term debt funds should stick themselves to only AAA rated type of investment holdings, and they could possibly make some decent returns in the current scenario, given the backdrop that I think interest rates are going to come down, and I think there's a general acceptance for only high-rated bonds in the market.
Yeah, very interesting, very interesting. So, actually, this is something that I have been hearing from a lot of my friends also. A lot of people are comparing this, market situation or the
Right.
correction or the fall in the market
Hmm.
to what we have probably witnessed in 2008.
Right.
So it's something probably more of a recency kind of a thing also that,
Right.
most of us have seen that and are seeing this, are comparing it also. So how much do you think are these things similar, and what are your views on this one?
So I think what happened in 2008 and what's happening today is quite different in terms of, I think, the magnitude of the problem. Also, I think we are into a much deeper problem today than we were in 2008. 2008 started with US. I think the problem kind of started from there, and it had a global implication because we were in a globalized economy and everybody got impacted. Today, I think we are seeing real issue on both demand and supply, whereas 2008 was only demand related issue. So I guess I think in terms of comparison, I think these two are pretty different. I would like to believe that this time it will take much more efforts from the central banks across the world, and also I think the banking system that will for us to kind of come out of what we are into today. Mm-hmm. So I see them quite different, and I think from an equity perspective also, I don't see the kind of recovery what we've had in 2008. Mm-hmm. V-shaped sort of a recovery. Probably this time it will probably be a U-shaped type of a recovery is what my view is.
No, I completely agree with you. I mean, I think probably this is something unprecedented. I think this is something globally we have seen countries being under lockdown. I don't think so. Obviously we have not seen in our lifetime,
right?
And probably our parents have also not seen in their lifetime. So this is like, once in a century kind of an event which has really happened.
Right.
And it is obviously very, very different from 2008 financial crisis because it kind of emerged from one country. Obviously, they used their central bank to kind of pump in the money to kind of take care of some measures to kind of curtail it, etc. I think that was more of the concerns, and because of which people kind of pulled out a lot of money from the emerging markets. But as soon as that stimulus came in, the money came back to the emerging markets. So emerging markets in 2008 saw a V-shaped recovery, as you said. This time, India is, I think, already under a very big slowdown, right? We're already seeing it for the last 2 years. And we are already struggling with it. And this thing is only aggravated our problem in terms of, we are struggling at the economic level itself. The demand supply, people's incomes, jobs, corporate people in terms of their earnings, etc. So I think this, as you rightly said, I think this will take much longer than probably we see. Sometimes, some discussions I've had is in terms of people really talking how actually Great Depression took a lot of time to kind of people to recover out of it. And
right.
Here exactly we're seeing that there is a global recession that we're seeing. It's not just
right.
India,
right.
Globally we are impacted. So I think the recovery could be much longer. So
okay.
I think my advice which I give to clients is that don't expect a V-shaped recovery. It's
right.
good time to invest. I advise good time to invest to kind of in the equity markets. But I think it's not that quick for the recovery. So, yeah, so it's
all
not
right.
same. I think it's
all
quite
right.
different. Yeah.
All right. Okay. So now maybe the last question, taking into account all of this, what we've discussed about equity markets, debt markets, and the current slowdown, and all of that, how should one go about investing? Like a very retail or an HNI investor, how should he look at investing per se?
Okay. So I'll basically share here what exactly I have been telling my clients also and what I have been advising. So, look, obviously we discussed that there is a debt kind of in concerns that we see. So AAA, as you said, is the kind of category to be in. But again, I have a slightly different view, and I actually ask my client in terms of their risk appetite, what they have. If you have something which you want to invest for 2 years, so I kind of advise, can you invest for 3 years or 4 years, right? So, because 2 years is neither here nor there, and probably if you make it a 3-4 year kind of a horizon, you actually have a much larger opportunity of making much higher returns in equities, right?
Right.
You're pretty much taking, a similar kind of risk in the debt side where you don't know whether the company is going to default or not, right? So, might as well take the equity risk and earn a much higher return in the range of, let's say, around anywhere between 12-15% or upwards, right? So I think be in the equity side if you can take that kind of a call. If you can't, and if you want be dependent on some kind of fixed income to kind of earn this thing, then obviously some short duration where maturities or the interest rates are not going to affect you significantly is something that I advise.
Alright.
So whether it is about some ultra short funds or low duration funds or to a large to probably the longest what I can kind of in terms of duration I can advise,
Right.
low duration or maybe arbitrage funds.
Right.
But equity I think is a great opportunity,
Hmm.
whether you pick a large cap, mid cap or small cap. Like
Right.
I have advised my clients to actually focus on mid and small cap funds because I see they have already beaten down in the last 2 years, and if you see the price to earnings level, these companies are available at probably a 10-year low.
Right.
So why not? I think in the next 3 to 4 years, you will probably make much higher returns in mid and small cap funds.
Alright.
So I kind of tend to give a little slightly more aggressive
Right.
advice to my clients, obviously
Right.
understanding their risk appetite.
Correct.
But I think there's a bigger opportunity to make higher returns.
All right. So I have a slightly different view. I am somebody. I think first I would tell investors to first go back and look at their asset allocation. I think that's the key for investing today. They should have proper allocations between the equities, debt, real estate, gold, and cash. And I think they should play out their investment portfolio accordingly. Then coming to different asset classes, like let's say equity, I think I'm somebody who would be more cautious today because I think what we are seeing is something. It is not something which we have been in earlier. I think there's a lot of unpredictability to how equity markets would deliver going forward. Especially, I think till the time we don't have a vaccine, we are not sure how it will all play out. So on the equities, I would suggest investors to actually be a little cautious, come more into large caps and at the most more into multi caps. And maybe I think once there is some sort of a recovery which is in place, then probably go and invest into mid and small caps. But yes, I would agree with you that if somebody wants to kind of be a little aggressive, they might as well come into mid and small caps to a small portion of their portfolio and take a maybe good 5-year view of investing. They could possibly end up making a better return. But yes, at this point in time, to be more stable, more secure, look at large caps, look at only blue chips, irrespective of the valuation they are, because they'll always command higher valuations in the times in which we are today. That is what is my view on the equities. My view on the debt side, I would also advise investors to look at more of these short duration funds. I think which is where you kind of don't take any risk of duration, understanding the fact that there's this issue with fiscal slippage and you have interest rates again kind of moving back and forth. So you will see a lot of volatility in the long duration debt funds. So stick to short duration funds. Look at arbitrage funds. I think that is the entire summary of advising on the debt side. And if you look at your entire portfolio, I think there could be a case where you could possibly look at a slightly higher allocation to equities because they've corrected so much today. So I think that readjustment, that rebalancing based on the current market dynamics can be done. But I think largely, what we've seen, this is a lesson in every crisis, that asset allocation is something which will help you to tide the crisis. So which is what I believe. So this is what my
I totally agree. I think I can't emphasize more about asset allocation,
right,
and more so going through the different cycles of market. I've realized asset allocation is so important.
Correct.
And the moment you do that, I think a lot of things in terms of taking calls of different asset classes becomes much more easier for you.
Right.
And one point I kind of missed mentioning is even in equities, because considering that this year is going to be quite volatile for equity market, it's always advisable to actually enter equity funds in a staggered manner, rather than kind of trying to time it and do a lump sum.
Right.
So I think use this whole year to enter into equity funds,
right,
and ride it for the next 3 to 5 years.
Right. So, and I think one point to add up to that is, I think usually investors would want to time out and they say that, okay, let this issue settle down and then we'll probably start looking at equities. I think quite honestly, timing in equities usually does not work. I think we've learned this from any top global successful investor, including Warren Buffett. Equity markets are smart. Any kind of recovery which the markets would expect, equity markets would discount it in a way that it will not give you an opportunity to enter. Correct. So they would preempt the earnings recovery, they'll preempt the growth recovery, and by the time you would want to enter, the markets are already up 10-20%. So I think some sort of a staggered investment is something which is something which will probably help you to kind of average out your investments rather than timing. And I think time, again, it is proved that this strategy works the best.
Okay, yeah,
Yeah.
that's great. That's great.
Yeah.
So I guess thank you so much, and
Yes.
thank you for being with us. I hope you liked our questions and the views.
Right.
And please feel free to put any more questions, maybe in the comment below, or if you directly connected with us, please WhatsApp us, and we'll be more than happy to kind of make such more videos and bring
Right.
to you the views about investing.
Correct.
Yeah.
Thank you all. Thank you. And we will be happy to kind of take any questions which you would have individually, or you could write it in the comment section. And looking forward to doing more such videos and maybe engaging more with you guys.
Right.
Thank you.
Thank you.
Thank you.